Earnings for beginners. There's a lot of opportunity during earnings season. Earnings come out every 4 quarters for March, June, September, and December. They show the earnings per share of a company. So how do we get the earnings per share? It's taking the net income and dividing it by how many shares outstanding they are, and this shows me how much each share really earns. So this is really important because the earnings show what a company makes before they have to pay interest and taxes. There's also before interest, taxes, depreciation, and amortization. These are called EBIT and EBITDA, respectively. They show the profit margins of a company. Now, each company could have different profit margins, but they all pay interest and taxes. So this is why earnings is really important and it's really key. Where can we find them? I use the earnings calendar that NASDAQ has. A lot of companies have an earnings calendar. I just like NASDAQ. They show the date that it's going to be reported and what the consensus for the earnings per share will be, what the analysts estimate it to be. If a company earns more per share than what the analysts estimate it to be, that means they beat earnings. If they earn less earnings per share than what the analysts estimate it to be, they miss earnings. This earnings can affect a stock price a lot, or it could affect it very little. So usually when companies beat their earnings, their stock price has a positive spike. There are cases where it doesn't. An example is last week, JP Morgan Chase beat their earnings, but their stock price still went down. So it is unpredictable. If a company misses earnings, usually their stock price will have a negative spike in price. I've made money on that negative spike and I bought it right after their earnings was reported. Now we have a calendar, we can see when companies are reporting their earnings. We can do some research on what we want to look for. The first thing is finding where companies report their earnings. This is usually on the company website under Investor Relations. Here you can find their annual reports and their quarterly reports, as well as the conference call. Now, a conference call is what beginners usually miss, and conference calls happen right after earnings are reported most of the time. They are with the CEO and the CFO, sometimes a third member, and this is where analysts get to ask them questions about the performance in the previous quarter. Second thing you'll want to do is look at historical earnings per share and how it affected the stock price. If a stock price is really volatile after their earnings per share is reported, then that means that earnings per share has a really high effect on their stock price. Some companies, however, don't have as much of an effect just because they have other measures they like to measure. Netflix, for an example, has net additions to membership, and this affects the stock price more than their earnings per share because it is more important for Netflix to gain members than have positive income. Okay, and lastly, we can also start researching a plan to make for when earnings come out. It could usually be you want to get in right before earnings or you want to get in right after. My example is that Skechers missed on their earnings and their stock price dropped over 20%, and this is when I bought equity. I also sold puts. Now, this put me in a position where if Skechers went up, then I'd have 2 upside, and if it went down, then I would be both negative in both those trades. However, Skechers did rebound after their earnings, which is what Skechers usually did. This caused the stock price to go up, which made my equity position worth more, and it also made the price of my put go down, and so I could rebuy the put and take the profit from what I sold it at. I did talk about options in this video. I'll be having an options for beginners video coming out this week. If you like this video, please like it and also subscribe. I post these videos early morning when the market opens, and this is when the information is most valuable.